Good morning, everyone, and welcome to our weekly edition of our weekly OakBridge market update. We are happy to have you here with us and have some interesting things to talk about today. This week, the Fed is going to again announce policy. They're meeting again this week to find out what they're going to do with interest rates. The expectation is for this particular period that they will raise the interest rates by 0.5% instead of the 0.75% that they've done in a number of the previous times that they've met. And this reflects a little bit of the cooling that's happening in the economy. One of the Fed's goals is to not overdo it with the interest rate hike increases. And so they are softening the rate at which they're increasing the interest rates just to kind of take a step back and take a look and see what's going on, see what the indicators are happening in the markets right now. So let's jump into this. The primary thing that the Fed is looking at right now is just inflation. And you can see here that we've got two measures of inflation and what's happening with those two different measures. The first one is the core goods. Those core goods represent larger items, larger purchase, durable items such as cars and refrigerators and those types of things. And you can see that with supply issues being worked out and the global chain issues being worked through, that there's enough supply. Actually, we're getting a little bit of additional supply now, and you can see that inflation rate is coming down nicely on the core goods. One of the things that the Fed is looking at, however, is that they have told us that the measurement that they want to focus on for raising of interest rates is this services ex shelter, meaning, and what this means is just day-to-day services minus housing, minus rent. And so you can see that this has come down a little bit, but has not come down nearly as fast as this core goods has come down. And this is primarily the one that they're looking at. As we look at this and try to figure out what is happening with that, JP Morgan has a great commentary on it, and they're basically saying that the November jobs report had a very mixed report. Some of the areas of that report were very high, higher than anticipated, and there were other areas of that report that were quite a bit lower than anticipated. So it was a little bit of a mixed bag. And what we notice also is that this services inflationary index is the last of the indexes that slows down. So in all of the measurements that the Fed is tracking, this services ex shelter is one of the ones that lag the most behind what's going on in the interest rate market and in other areas of the economy. And so they have to be a little bit careful with this of over tightening too soon, because if they continue to tighten, this may plummet and it may continue down for a period of time because of the lagging nature of what it is. So again, they're looking at pausing for just a minute or at least reducing the amount of interest rate that they're going to increase. And again, the announcement will be tomorrow. And so we're guessing, right? And a lot of most of the economic people that we're looking at and that we're following are projecting that it'll be a 0.5 point increase this time, so that they can take just a little bit of stand back and look at where things are going. So longer term, one of the things that we're looking at also is just the overall portfolios. In the past, bonds weren't doing anything at all as far as interest rates. The bond coupons were very low, and it was hard to get any type of a return whatsoever in a bond portfolio. With the interest rates now having increased over the last year and 12 months, the projections are that we should have a fairly strong bond market going forward. And with that strong bond market, we now should be able to transition the portfolios a little bit more over to a little bit more bond weighted rather than so heavily weighted in the equities as many people have done in the past. And what that means is that we should be able to take a little bit less risk in the portfolios and still get the returns that are needed for your long-term goals. In the interim period, however, we still need those equities to come back, and transitioning those portfolios becomes a little bit of a balancing act, because we don't want to sell out those equities when they're in the negative so far still. But it does become a little bit of a balancing act, but it does provide us a little bit of light at the end of the tunnel, that going forward, we should be able to have a little bit less risk in the portfolios and still be able to accomplish your goals. With that, we'll wind it down for today and say thank you so much for joining us each and every week. We appreciate it very much. If you have friends, relatives, associates, neighbors that would like to listen to this podcast, we are absolutely delighted if you would forward that link to them. And with that, we'll sign off for today. And thank you so much for joining us.